$3,000 an ounce spot price gold was briefly breached today. We're going to need to start with that. It's after all the headline-grabbing, nominal round number fiat dollar devaluation story of the week. The truth of this ongoing story is simple. It's not gold going up in both nominal and real terms. It's the larger, simultaneous story of all our collective fiat currency units losing value versus bullion over time. I mean, how could they not? After all, just stare at the sheer lunacy of this system's rampant fiat currency creation on a global scale. Gold still has to account for the collapsing confidence such irresponsible actions produce. US stateside, the story is not new. Fiat M2 is now re-ramping higher, back towards COVID 2020 high levels. Measured by gold, internally, fiat US dollar M2 supply is still well above the 1975 lows and the 2011 lows, and of course the 1980 lows, which would require a 5-figure gold price at the moment to simply match. Now, cut again to today's long-term gold price. I'm still struck by the speed of nominal price escalation. Drawing lines from the $2,000 to $3,000 move, the only section of this 21st century gold bullion bull that was faster was the mid-2000s ramps, which had price volatility between. Those two more vertical price runs in the mid-2000s happened all before the infinite QE era, by the way. Here's a fun, quote, free gold price era factoid. 1,000 ounce gold was reached about 40 years after the London gold price rigging failure in March 1968, and about 36 and a half years after Nixon defaulted on our sovereign gold withdrawing trading partners. 2,000 ounce gold followed within another 12.5 years. 3,000 ounce was surpassed today about 4.5 years later. Now I know what you're thinking, maybe $4,000 an ounce gold sometime in 2027 if the progression continues. We'll see. Nothing comes smooth in a bull market. You have to climb walls of worry on a short and even medium-term basis. Yet still, Goldman Sachs now estimates global central banks are again buying mass gold in the ongoing bullion reserves over bond trade thus far in 2025. The world is realizing too that the overpriced Mag 7 is no longer a store of value and things don't go to the moon forever. While the new Trump administration is staring a deadly combination of both higher Social Security expenses and interest on our exploding debt levels climbing, that's perhaps one reason they would like to force the Fiat Fed to recommence cutting interest rates by shaking the stock market. This fiscal year, in terms of interest expenses, is worse than last to start. The U.S. budget deficit is worse too to start. Outlays are up plus 38.5% thus far this year versus last year, 5 months into the fiscal year. The deficit is simply almost $300 billion higher versus this time last year. So another look, sober up. We have a drunken sailor spending problem, and it's still going. At the same time, the relative fiat US dollar strength is no more. Now, of course, that's the stated goal of this administration, so they are getting partly right so far. But this, of course, is why we brave few bullion owners, we saw the writing on the wall years leading up to this. And gold to start this year is merely mirroring value gain rewards for our being right and holding tight prudence. This gold revaluing higher phenomenon is also happening more and more versus the U.S. stock market. This is a long-term chart of the S&P 500 divided by the gold price going well back behind the 1929 stock market crash. We're still hovering above where the 1929 crash peaked at in terms of relative gold valuations then versus now. This key ratio closed today at 1.89 ounces of gold to afford one nominal share of the far still bubblish S&P 500. Now a quick aside on something I looked up today I found interesting. I think you will too. That iconic October 1929 picture of Walter Thornton selling his 1929 Chrysler 75 for $100 in cash. Well, when it sold for new, it sold around $1,500 at the time, an equivalent of 72.5 ounces of gold. And that was, of course, before the great tanking occurred that stretched from the 1930s through the World War II era. He was selling that car, I'm not sure exactly how long used, but in that photo he's selling it for just under 5 ounces of gold equivalent, or 100 cash. So yeah, talk about a wealth transfer. Well, Thornton happily went on to found one of the big three modeling agencies later on in New York City. It seems Walter lived a colorful, successful life later on in Mexico, living all the way until 1990 with a large family of 6 children. Now, to paint a similar picture in today's world, that would be like some YOLO over-levered bubble clown buying a McLaren Artura, a plug-in hybrid supercar with a base price of around $225,000 entry-level model, and then selling it in another great taking for just under 6 ounces of gold equivalent in cash. Of course, things akin probably won't happen as fast as they did in 1929. After all, it's a big debt and derivative-laden world, comparing now versus back then. But my long-run bet is that examples like this will rhyme in time. You see, gold has deep forensic reaccounting work ahead globally. We are hopefully now nearing our collective ways out of this post-COVID 2020 golden age of frauds, with gold likely eventually going into another bubble perhaps in the 2030s. Now remember, they took gold out of most Western world business school curriculums 1970s onwards, which is cool, because we're self-taught. I still learn something new near every day in this lovely, nutty bullion market. The fact that gold knowledge was robbed from most Western curriculums, and especially here in the US, also means that myopic financial advisors are also all gold illiterate now too. High 90 percentile chance that they correctly think I'm dangerous to their books of business. I've been pounding the table on bullion since before global financial crisis 2008, and I got the scars still and downside market rigging memories that will not fade and hopefully help keep me grounded along the way. And just over 5 years ago, I came on this SD Bullion channel and began pounding the table for any and all to see, with my name, face, and reputation on the line. I don't regret it at all. Here's a brief look back of how far we have climbed.
The formula for our weekly bullion market update is still obviously in its infancy, and we really want to hear from you out there. Tell us in the comments below what kinds of information and updates which could bring you consistent value. Let's start by digging into major precious metal price action for the past week and look at some of the supposed drivers for why spot prices got so clobbered. The silver spot price fell over $1.30 per troy ounce, closing this week at around $16.87 per ounce. The gold spot price had its worst week in nominal price action since President Donald Trump was shockingly elected in late 2016. That night, the gold price immediately shot up $50 an ounce on the news, only to get hammered down $100 an ounce the very next day for reasons no one has ever been able to explain. This week's gold price is closing around $1,460 per ounce. Well, that's about $55 off of last week's close.
Stick around, fellow silver bulls. On the other side of this break, we'll get into a few more recent reasons why silver has only begun to warm up, and how even former commercial bank desk heads are publicly admitting that GLD is a slush fund proxy versus bullion, especially for unsecured retail investors. Hello there, this is James Anderson on behalf of SD Bullion with your weekly bullion market update. Please smash the like button, subscribe, and share this content with those who also might find value. Before we continue with this week's bullion price action and other news, a quick reminder about SD Bullion's new IRA streamlining service offering.
Like, oh, sir, this could take 4 to 6 weeks. Man, this process is really broken.
What we've done at SD Bullion is we've taken everything under one roof. Transparent pricing, you know exactly what you're getting. All the metal comes into our facility under camera. It never leaves. If you want to sell back, if you want to take a distribution, these processes that would take you 3 to 6 weeks to do at another program, we'll ship that out in 1 to 3 days after you decide you want to do that.
The spot price of silver and gold ran higher this week. The spot silver price briefly pierced $34 an ounce, closing at $33.70 an ounce bid. The spot gold price, after piercing $3,000 an ounce, settled back at $2,987.95 an ounce bid to finish the week. The spot gold silver ratio briefly fell to 87, only to close at a still historically high level of 88. Of course, the start of silver has been torrid versus all-time averages throughout this full fiat currency era. Yet this chart is something you can stick in a myopic stock bull's pipe and tell him to smoke it. This century, the black line illustrated here, That's the performance of the broad stock market, even with all stock dividends reinvested, as if you were Warren Buffett, of course, without sweetheart insider deals. Well, your gains thus far would still be well below gold thus far in this century. And after this recent bull run in silver, it too is now on the lead of even the compounding dividend stock investing crowd for this century. Now, I'll leave a Longtime Trends website link for you to go look at that if you'd like. Don't show your trusted financial advisor it, please. I'm here for entertainment purposes only. Onwards to the GLD slush fund, the one that long-term gold bullion bulls should steer well clear of. Here's alleged commodity expert Mike McGlone of Bloomberg today speaking at what is supposedly happening in the gold market.
I think the key reason gold's rallying now is because it's anticipating the deflation, significant potential deflation if U.S. risk assets, most notably the stock market, can either say go down or mean revert, because it went up so much the last few years. I think that's what's happening now. The gold market's anticipating stock market going down. Okay, that was been the best place to be, along with cryptos for decades now, along with high bond yields. And now gold's starting to understand that, that rally might be over, and you're seeing that in ETF flows. ETFs had outflows for 4 years in a row, and they're really kicking in this year. They're up about 4%, which would be the most since 2020.
Now, he posted something similar to that regarding unsecured gold ETF inflows, a commentary he made this week on LinkedIn, only to be shot down with the following by a former commercial bank precious metals market maker and another World Gold Council member who admits that palladium ETFs got raided late 2010s when push came to shove. Robert Gottlieb stated, "I don't think all that was buying. When it comes to GLD, when gold lease rates shot up as forwards moved tighter, there was a big redeem in GLD. It wasn't a sale. Someone borrowed GLD and redeemed to use the gold. When lease rates went lower, the borrowed GLD was returned and a new crate was done. Looks like buying to you, but wasn't." Then John Reed chimed in by stating, "Robert Gottlieb, I think that is spot on. ETFs were used as a source of local London liquidity in January and early February, hence decline in gold ETFs in the U.S. listed vehicles that we reported. When the cost of borrowing ETF securities climbed, this trade stopped and is now reversed. I've seen the same in PGM some years ago when genuine shortages of metal triggered ETF redemptions so people could source metal liquidity." Now, a quick look at the palladium raid that happened in the late 2010s, if you forgot. And I contend that when push comes to shove in the silver and gold markets, that's going to repeat again. Turning to the EU and Germany, which has an energy infrastructure mandate to the tune of now $500 billion fiat euros through 2037. Hey, Bloomberg Neff, it looks like you're going to have to make the aqua-colored silver solar panel demand estimates grow larger and higher again. So here we are again on this full fiat currency era, Swiss franc versus gold on the left-hand side and silver on the right-hand side chart. If silver indeed follows gold, silver in the Swiss Alps still needs a double and a half to still reach its seemingly ancient 1980 price high, and then much more powerful fiat francs at the time. Oh, you don't think silver follows gold? Well, take a look at India. They're just ahead of the curve, I would argue. Let's hear a quick clip from our Indian bullion bull queen, CNBC TV 18's Manisha Gupta, as she pulls out where Indian silver imports were at last month, February 2025.
Nitish, a lot of gold jewelry guys tell us that the gold jewelry buying is down by 30 to 50% given the high and volatile prices. Are you looking like that when you look at silver as a segment, or no, there hasn't been much impact?
No, see, people are not buying gold because they are buying silver, I feel.
Okay. And how much of silver imports have you seen? Because last year was good and 2023 actually was a record number. How are we looking at this financial year? This year it's a bigger record.
This year actually the silver imports have almost doubled. Not exactly doubled, but almost doubled. Okay. And again, the industrial usage is one of the major factors for it. And because a lot of make in India is happening and all that. So, in EVs, in EV batteries, and silver being a component, which is good at conductivity, much better than copper. So the usage today, towards energy, silver is being used quite a lot.
So any sense of numbers on what have we seen for imports in the month of January or for this financial year until now?
January, February has been close to about 1,800 plus tons.
Metals Focus has not yet corroborated that India silver import February 2025 and January. Well, they've done the January data point, but not the February one yet. But the bottom line here for India is that escalating gold prices and a still stubbornly high gold-silver ratio is driving investors in India more and more into silver. And you could see it in their net silver ETP inflows over the last few years. An 1,800-ton inflow, or two 900-ton month-sized bars on this long-term Indian silver import chart, that's still good inflows into a market that is not only using silver as a cutting-edge industrial precious metal, but also as a long-term store of value relative to value-increasing gold. Well, it's been a good week, my friends. Here's to the next. That's going to be all for our weekly SD Bullion Market Update. And as always, to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.